Hello and good afternoon in my case. So probably you're listening here from Australia. So then good night, I think. Yeah. Hope you had a nice evening so far. And if you're watching from London, somewhere UK, then it's also UK. If you're watching here from probably somewhere like Tahiti or something, Bora Bora, then it's like very early in the morning. However, it's an international webinar here, and I welcome you. I hope that you will enjoy it. I'm the moderator. My name is Jens Klatt, and yeah, today you can already see it here. I want to introduce to you a simple sentiment-based EURUSD trading strategy, in fact, and yeah, to get already an idea of what we're talking about here, we want to answer the question how to use human behavior to find an edge in our trading, in your trading, in fact. Yeah, as usual, let's have a look here at the agenda first, in fact. So we want to introduce to you something, or I want to introduce it to you here. 1 second, let me just see. Everything fine? Yes, okay, great. I want to use a concept which was already introduced, I think in August, if I'm not mistaken, at the beginning of our Trading Spotlight webinar series here. So there we had the webinar where we focused on emotions, on trading psychology, and there was a concept, a game, probably remember it, when we illustrated loss aversion. And how you tend as a human being to let winning trade to cut losing. 1 second, to cut winning trades short and let losing trades run. Complete opposite of what you should do in trading to become profitable. That's usually that it's a given saying, where it's a given among profitable traders, that they say let winning trades run, cut losing trades short, and you're already on a very good way then to become profitable long run in your trading. And that's based on a cognitive bias, and this is what we want to here recall and then use it, in fact, as an idea to to formulate a proven profitable trading setup based on something many already also may have seen somewhere in the internet. When you're clicking through the World Wide Web, you probably may have come across a concept which is called crossover system trading, or moving average crossover systems. This is simple moving average, exponential moving average, and you use them, and then you get a trading signal being generated once one MA crosses the other, in fact. And this is the basic idea behind this. And then we want to use human behavior as a filter, if you want. The question is, where do we get this data from, or how is it collected, and how to use it then? In fact, some of you have already seen on the website from admiralmarkets.com there is a section where you can get market sentiment. In fact, some of you probably use the Supreme add-on. Some of you remember probably the webinar last week here when I introduced to you here my favorite 5 add-ons in this Supreme add-on package. So there was also the sentiment trader, and in fact we can use this sentiment trader here to get an idea. I introduced already kind of a concept to you to use it as a filter in your trading, to say retail traders usually tend to trade against the flow, let's say, or against the trend based on this standard human behavior, a loss aversion, which means if they are net short, you should go long, and if they are net long, then you should tend to favor short engagements. And this is, in fact, already the basic idea behind what we want to introduce here today. The answer where to get the sentiment data from will be easily answered, in fact. And then I want to show you how the setup looks like. It's getting a little more technical. It's optimized over the years. Then surely, as usual, I want to show you a backtest here, and I want to show you that it really worked pretty well over time, even though the backtest I show you here is within a time span of 4-5 years or something, and I kept on trading the strategy after that. So but I have no data here collected on the trading results. So the live trading results I'm not allowed to show them. In fact, it has been profitable. I could show them, I would show them, but I'm not allowed due to regulatory issues here with live trading accounts. So we focus only here on the backtest, but still you will see that it's quite interesting, I think. Yeah, who am I? I usually, or not usually, but today also, I don't want to talk about myself. So my name is Jens. The only thing I'd like to say here is I'm located in Berlin, in Germany. In the chat box, in or below here, this video, if you watch this on YouTube, a recording, you will find a link to an interview I gave to Admiral Markets. I think it was in June or July, before we started this Trading Spotlight series. And there you can get already an idea of how I got started, where my career started in the financial markets, and everything was quite classical after the finishing school here, German university entrance diploma, which we call here in Germany Abitur. I started working with a bank, and then took on from there, landed at a stockbroker after, and everything. But everything is described around this here in this interview. So it's probably the most interesting thing. But I'd like to focus, as usual, on Admiral Markets, the company, the broker, the FX CFD broker who makes all this possible here. So this Trading Spotlight series, which is, in my opinion, quite unique. And you can also see the uniqueness of this offering in our so-called Traders Yard community. So we have a community. You can ask all the questions right here. You can ask the questions below this video if you watch the recording. But you can especially ask every day and interact also with us as the traders here who will present to you this content. You can interact with us within this Traders Yard community. I will also post a link here below this video. Respectively, you will also find it in a few minutes then in the trading chat box. I want to switch over there, in fact. And so yeah, Admiral Markets is a broker which is offering over 8,000 financial instruments, a real multi-asset broker with offices in over 20 countries around the globe, fully regulated, FCA regulated, SISEC regulated here. This is due to Brexit issues and everything. So if there's any trouble in regards to the regulation, probably this is something we should yeah, also look the longer term then in this case. ASIC regulated, this is the Australian regulatory body. So you can see fully regulated broker for all questions in your respective mother tongue. Feel free to reach out to the Admiral Market support. You can, I somehow guarantee you, not by 100%, but let's say at least 95, that you will reach out to someone who speaks your native language, and then you can feel comfortable, ask all your questions there. In Germany, let me just probably bring this up here. There's also an office from Admiral Markets here in Berlin, in the city I live in. But when we talk about Admiral Markets, it's probably more interesting. We talk about Admiral Markets as the so-called DAX expert. And what do you mean with DAX expert? It means that Admiral is offering in the CFD universe probably one of the most competitive offers when it comes to DAX trading, with a 0.8 pip spread on the DAX. And there's also the offering when it comes to scalping traders, very short-term traders then, that they offer a 0.2 spread with the commission on top of that. Feel free to reach out to admiralmarkets.com right now, by the way. They have an offer already in anticipation of Black Friday next month, with giving an offering of rebates here. So on your paid commission of up to 50%. For all details, please feel free to reach out to the website. So very, very competitive offering, in fact, and definitely worth a look. And so that's it with the introduction. Let's start with the basic idea now in this trading strategy. So the basic idea of today's webinar here is our spotlight webinar, in fact, mastering your trading emotion. Some of you probably remember it. And there, within this webinar, we pointed out that one of the key reasons for retail traders being unprofitable is a cognitive bias called loss aversion. So I already called this cutting winning trades short and let losing trades run. And now it's very interesting. So you could leave it there. I already introduced also the mental reasons. 1 second, by the way. Just have a look here. Everything fine? I hope so. Yeah, okay. The thing is, okay, perfect. The thing is here, we could leave it there and say, okay, this is one of the basic problems. And then we could start to formulate ideas around how to overcome this natural human behavior, this loss aversion, which is something we can't really, we can't really overcome. It's in us. It's over thousands of years, it developed naturally. So it started out when we were still sitting on trees and hitting ourselves with sticks. It was during that time that we focused on safety first. So especially men, for example, went after, it's just mammoth, so big elephants, you know, and we had to make sure that we can feed our family. And if there was just a small piece of meat somewhere lying around, we picked this instead of going for the big mammoth or the big elephant. But we took this piece of meat then and brought it back to the family. We feed them for, let's say, 1 or 2 days. If we went for the big elephant, the mammoth, okay, well, then we probably would have had meat for, say, 2 months, but at the end of the day, it was a risk we take there, and so we took the small piece and brought it back. And this is something which is naturally within us, and which is right now or over the years a problem for us when it comes to trading, because here winning trades and going for the home run, let's call it, is what at the end of the day probably pays or results in the overall profitability of a trading approach, while hope within us is like we hope that something gets better, even though it's probably not likely to happen, whatever I'm right now talking about. But you can use this as an example in everyday's life, in fact. And there's several occasions when you probably say, okay, well, I don't know, my wife is not cool anymore, whatever. So I probably should think about the divorce. Okay, this is a very dramatic example, but sometimes from a rational perspective, it makes probably more sense also for children like this, right? So just think, okay, we are bad examples here for our children, and so probably makes sense to divorce them. And now the thing is, nevertheless, you stay with them. The example is a little difficult here because there are several reasons to probably say, okay, now I have to work on it first before I just throw in the towel here. But just imagine, sometimes we tend to just keep the losing trade. Okay, this is very difficult. I just hope so badly that my wife never watches this video. But I hope you get the idea behind this. So if we think about this now a little deeper, then it's natural within us. But if we start to analyze this loss aversion, okay, then it means, in fact, that winning trades stay in the market for a shorter period of time than losing trades, right? So if you cut your winning trades short, it means from a natural perspective that the average time the trade stays in the market is shorter, should be shorter than a losing trade stays in the market, okay? Okay, so this then is something we can use in our trading, in fact, and use as an edge, in fact, in trending markets. So let me first show that this basic idea is really something which you can find in the real world. This is a chart I created, in fact. In fact, the basic chart I use here is a German chart. So a chart which I used in my first book I published in 2014. It's on Forex trading, in fact, but the thing is, it's a German book, so it doesn't really make sense. Right now, we're talking about English content, so, and most of you guys will mainly speak English instead of German, so it doesn't really make sense then to make this book a topic, but the basic idea here was also to write something on retail sentiment. And here I used this chart, and this illustrates, in fact, the sentiment ratio. So a ratio here of retail traders being long in relation to retail traders being short. Real live money account, real money accounts here were used in this case. So, and if you had here such a column going down, red, that meant that, or that means that retail traders were net short. So for example, it means if you have, for example, a -2 here, it means nothing more than on every retail trader who is long, there is minimum 2 traders who are net short. And then you have a relation of 1 to 2 in this case, and respectively -2, 1 to -2. And what you can see here is the overlay in blue. There's a EURUSD chart. So from, in this case, it's the beginning of 2013 till mid-2014. And what you can see is that if the market trends higher here, so there's a sequence of higher highs and higher lows. Clearly, you can clearly see it. The blue line going up from here, here from around 126 to 140 around, that when it started here, then the market, or the sentiment, switched to net short. So that means nothing more than retail traders here with real money accounts started to fade the momentum. So, which means nothing more, the market trended higher and they kept on holding on their losing position. So what you can see here, for example, is they were net long, and then the market starts to move up from there, and they start to build short positions into this up momentum in this case. So they try to catch the top, in fact. And what you can see is, in fact, that here they were short for a quite long period of time. And in this case, for example, we're talking about 3-4 months from here up to these highs, and then the market tends to see a very aggressive drop, whatever reason. Probably some ECB meeting or something, someone from ECB telling, yes, we have to bring up QE or something. In anticipation of that, you see here a sharper drop, in fact. So, and what you can see is that within a very short period of time, in fact, several days, probably even hours than that, probably even hours, you can see that the market came from nearly -6, which means on every retail trader being net long, there's 6 who are short. They aggressively cut down their short position here and went down to -2. So there was nearly this number here, or the number of short traders being positioned within the currency pair, that were cut by 3, or not by 3, but it was divided by 3, in fact. And what you can see here is then that the moment the market moves in direction of the retail traders, it's very quick that they start to reduce their short position, in fact. And this is what gives us the basic idea, or which underlines the basic idea, that winning trades usually stay shorter within the market than losing trades. So here in this case, in fact, retail traders tend to permatize into losing trades then, and build also here even higher position, averaging down and hoping to somehow, in this case averaging up, in this case hoping that even a small move here will then bring them in the winning zone, and they can close the position even with only a small profit. So this is how the basic idea then looks in the real world. There's also 2 other charts I already presented to you. In this case here, we have the average gain in blue and the average loss in red in different markets. So here, it's not only EURUSD, the currency pair we want to focus on here, but there's also like gold, there's the DAX in this case. We also have EURJPY, for example. You have US 30, so the Dow Jones, for example. And what it shows is that on average, on every gain we had here, average gain, which is in EURUSD, for example, 20 pips, there was a loss of 40 pips, in fact. So which means nothing more than this is the real number behind the idea, or behind the saying, retail traders tend to cut winning trades short and let losing trades run. So this is exactly what can be seen here. So if the blue column, which is the case in every case, in fact, in every asset, is lower than the red one, this is what gives the real world example to the saying, this is the natural tendency of retail traders, cutting winning trades short, let losing trades run. The only problem we have then is that if we have here the hit rate in gray versus the loss rate in different markets, that you can't overcome this tendency. So we won't do this because we want to focus on the strategy in the first place. But if you say here, wow, EURUSD, as we are looking here, some of you probably remember the numbers, the stats behind this. There's 9.2 million trades we analyzed here. So on not over 9 million trades, there was a hit rate of 60%. This is awesome. This is really awesome because retail traders obviously have a natural tendency on analyzing the markets really well and get a really good feeling on how to where to find the advantage currently. If the market is extended, it tends to bounce back or something. And then is natural, not just a natural tendency to analyze markets really well, but in addition to that, we're trading very small sizes compared to big institutional guys. So we are very quick, very flexible in entering and exiting the market. It's not that we enter the market with, let's say, 5 yards or something. So being long EURUSD with 5 billion units or something. But in our case, it's a way smaller number, and we're not tending to move the market, even though we have to say KFX markets, even here 5 yards is probably not capable of moving the market. But you see the point, right? So we are very flexible. And so the thing is that this flexibility or this advantage we have as retail traders is not used. It's in fact, in most of the cases, not used. And if you put in these numbers, average gain to average loss here to the hit rate of nearly 60% and 40% losing trade, you find out that on average still the retail trader in this example here is using something like 2 pips per trade, which means if using very high leverage, it's only a question of time. It's a negative expected value. It's only a question of time. It's not the question if, but only a question of when the account will be crushed and the retail trader will leave the market or has to leave the market because the account is just was busted. Okay, so this is how the basic idea looks in the real world. So now, first of all, before we formulate the strategy, we have to give a definition here of this MA crossover strategy, which is in fact really, really simple. So first of all, we look for 2 moving averages. In our case, we can use several, but in our case, it's 2. And we make it really simple. In fact, we use the SMA 20 and the SMA 50. SMA means nothing more than we have a simple moving average. 20 means we have 20 candles. We add them up and divide it by 20. You get a number, and then you do the same here for 50 candles. You add them up, you divide it by 50. And you do this again and again and again, and based on that, you get a moving average, in fact. And then you say, once the moving averages intersect, trading signal is generated, which means the faster, in this case, it's the 20 SMA. If it crosses above the slower MA, then a long trade is taken. If the faster crosses below the slower MA, short trade is taken. And this works obviously well in trending markets. So this is an example, a chart here. So we have in blue, we have the SMA 20, and we have in red the SMA 50. And what you can see here, the SMA 20 crosses below the SMA 20, SMA 50. So this is a short signal being generated. And once it intersects back, it crosses back above here, the SMA 50, the position is exited, and then you enter directly a long position. In fact, because now the SMA 20 crosses above the SMA 50. So this is the basic idea. In this case, we are looking here at the EURUSD hourly chart, in fact. And that's it. So nothing more to say here. This is how a system works, respectively, under which market conditions works well, respectively. Also, what's the basic idea? So if you see a lower, faster moving average crossing above the slower moving average, you're long. If it crosses below, then you're short. That's in fact it. Okay, so, okay, this is now a little, that's not so cool, but okay, let's go through every point. It would probably be better if this pops in here, because now we have very lots of information here. But let's just work with that. I think it still works. So we can say where I already said when we enter a long when we enter the market long here, in fact, the basic idea and the moving average strategy. But you see, we're not looking at the simple MA system anymore, but we now look at something I call FX sentiment MA, in fact. So, and there is an and included. So it's not only that we go long, respectively short, if the SMA crosses the SMA 50, SMA 20 crosses the SMA 50 on H1, but also in addition to that, there has been, or there is a filter included, which means that the retail sentiment here is net short, respectively is net long, okay? Which means that you only trade this cross of the SMA 20 above the SMA 50 if the retail sentiment is long, respectively, if you only trade the short side in case of the SMA crossing below the SMA 50 if the retail sentiment is net long. I've prepared this already on the website. Let me just switch over here. Let me just see. I hope it's here. Yeah, that's perfect. So this is the website. No, not really the website. So let's go over to the website first and then click here to the section. So admiralmarkets.com. This is the website we're looking at here. And let me just, by the way, here. So this is admiralmarkets.com. And then you go to analytics. And there, I'm sorry, is it right? Yeah, there's analytics here. And there you have market sentiment. So if you click on market sentiment and analytics, let me just take out the regulator here. You get market sentiment, and I enter here the link in the chat box. So, and then you can see it already. We want to focus on EURUSD solely here. EURUSD 63 in red, that means the market is currently net short, okay? So that means, differently put, if we know, let's assume that's the case. I haven't opened the Admiral Markets trading platform here right now because it's too resource consuming for the system. So I'm a little afraid that if I open the trading platform here on this laptop, then probably this webinar will probably get stuck. So I haven't opened it. I have opened the platform here with a VPS in case, in this case, so I could easily click and then see on a separate computer running here my trading respective of my systems. But in this case, I haven't opened it here. But just to give you an idea on how this works now, we only trade long signals in the current market environment. And it means if the SMA 20 crosses below the SMA 50, we are not taking a short trade since the market is net short. The retail sentiment is net short, okay? And the other way around, that means if the blue one is bigger than the red one, let me just see, yeah, Euro GBP, for example, we are only taking short trades. So if the SMA 20 crosses below the SMA 50 here, if we are looking at Euro GBP, which we don't do, I don't know whether this aggregation works or not, by the way. So I have a result, proven profitable strategy only on Euro USD, a very liquid currency pair. But just assume that this would happen here, and we have a net long. We only trade the short side, respectively, if the SMA 20 crosses above the SMA 50, while the retail sentiment is net long, we're not taking the trade, okay? So this is where you get the sentiment data from then to find your current mode in the market. Then we have our entry signals being generated. Now the question is, what about the stop? What about the potential take profit levels? And the stop is a little difficult, or it looks at least a little difficult. It's something which I included after coming to the conclusion that the volatility-based stop is probably working quite well with this approach, which you can see in the backtest result, in fact, that this is the case. So when we work with a volatility-based stop, I like to work, first of all, with an ATR 14, which means we are looking here at the so-called average true range. This is a standard indicator, but then I want to multiply this ATR 14 based on the current volatility we see in the options, respectively, future market. So, and therefore, I look at something we know as the Euro FX VIX, EVZ, it's in fact. So if you click on this, let me just, yeah, perfectly, it pops up. This is a number probably many just don't really know. But let's have a look here. I call this EVZ. Okay, it's from Bar Chart. This is also a website, by the way, which I highly recommend in regards to the Commitment of Traders report. When looking here at the futures numbers, it will be published every Friday. But this is another sentiment we don't look at here, but I remember that Paul had a webinar on how to use the Commitment of Traders report, which he uses most likely in a pro-cyclical way, because here we look at large speculators and those people who are usually very well informed, like CTHs, hedge funds, and everything. And based on the volume they trade, they have to use the market flow, respectively position themselves with the trend, not against the trend especially. So if we would use a Commitment of Traders report with this approach, which we don't do, but if we do, we would use it in a pro-cyclical way. But this is just a side note here. We look here now at the EuroFX data from another perspective. So we look at the so-called EVZ. It's like, probably you have heard about the VIX. The VIX is the volatility indicator or volatility index people refer to when looking at equity markets, like in this case the S&P 500, the US index. Here, if you want, we have the EuroVix. This is nothing more, nothing less than that. And so what I do here is I look at this and then I find the multiplier for my ATR 14, which means, for example, if I have an EVZ, as we have currently, let's just switch back here again. If we have an EVZ, which is bigger 5, so you can see it here, quote overview, there you have the EVZ, which is 5.6. That means that we would multiply our ATR we have on H1 then in this case, so this is the chart we're looking at, we multiply it with 2. Once the EVZ trades bigger 10, we would multiply it with 2.5, and so on and so forth. So in this case here, currently we multiply the ATR with 2, while the take profit level here was then placed in a distance of 3R from the entry price. So if you want, right now, make a screenshot of this. So then you have the logic behind this chart we will look at in the next slide. So just screenshot it. If not, watch the recording. It will be on the YouTube channel from Admiral Markets over the weekend. You can screenshot it and then test it yourself with these parameters. Work quite well, but the backtest is something we look at in the next slide. So again, here is our chart. You remember that was the one which generated the SMA signal, and now you might laugh. Did we take this trade once the SMA 20 crossed below the SMA 50 here in this example? That's a chart from August, by the way. I took this screenshot here from August, and the answer is no. We didn't take a short trade, and the reason is because retail sentiment during this time was in fact net short. So if it's net short, we remember we only take long trades. So no short trades have been taken, but it has been taken once the market crossed back. It was very surprising, in fact, to see the sentiment behaving that way, but it happens. From time to time it happens, but it's not a big deal. In fact, it's not a big issue. But we're capable of taking a trade here once the SMA 20 crossed back above the SMA 50, since the sentiment was still net short through or within this period here. And so we took the long trade here with the net short being with the sentiment being net short, and our entry long was in this case, so that was once the crossover happened, was at 0975 in EURUSD, 0975. So look at this. The stop was placed at 09.55. Why was it placed 20 pips lower? It's in fact very simple. I'm sorry, the 12 pips is wrong. It should be 20 pips. It's very simple because, oh no, it's right. Everything's correct. It's right. It's 12 pips. But the stop should have been here, not at 55, but in fact should have been at 63. The ATR, this is what you can see here below the chart. The ATR during that time was 6 pips. So EVZ during that span was 7. We remember, let's go back to this slide here. If the EVZ is bigger 5 but lower 10, we multiply our ATR with 2. So if the ATR is 6, 6 multiplied with 2 comes down to 12 pips. So that means we place our stop then, in this case, at 12 pips lower, in this case 0975 at 6.3. And the take profit, again back, is multiplied with 3. So if this here is 1R, 12 pips, our take profit has to be multiplied with 3, which means 12 multiplied with 3 is 36. And then our take profit has been reached, in fact, at 10.11, where it has been placed and has been reached shortly after here at 1:10.11. Okay, so this is how the trade, how the idea behind this looks in the real world. I'm really sorry. I could imagine, to be honest, I really realize this right now, that some of you probably look at all these numbers and everything and just think, okay, this is so much information. Like, okay, when it crosses, then only long trades are taken once the retail sentiment is net short, and here the EVZ and everything. Just again, screenshot this slide and go through this step by step by step by step, and you will see it's quite easy to understand, because the system generates the trading signal is generated once the simple moving average is crossed above or below SMA 20, SMA 50, and you decide whether you take the trade or not based on the retail sentiment. If it crosses long, so from the SMA crosses above the SMA 50, a long trade is taken, but only if the retail sentiment is net short. If it's not the case, you don't take your trade. Okay, and then you look at the ATR. Once the crossover happens, and if the ATR is, let's say, 10, to take a simpler example, here it's 10, you look at the EVZ. The EVZ is most of the time between 10 to between 5 to 10. You multiply the stop, then in this case the ATR, with the 2. 2 multiplied with 10 is 20. So this is the stop width you have to use. So from the entry price, you subtract, in the case of a long trade, you subtract 20 pips. And to get the take profit level, you multiply the stop, which is 20 pips, with 60 in this case. And then you get from the entry price, in addition to the entry price, in addition to, or with those 60 pips, you get your take profit level. That's it, in fact. Yeah, and this is what you can see here within this chart. So what's probably even more interesting, after you probably grasp this quite simple concept of how to enter the trade, how to place the stop, and how to take or post the take profit, or get the take profit level. The question is this really profitable? And so what you could do is you can formulate a system based on that, and then run a back test, which I did during this time span. So yeah, it's a little more than 5 years. That was when I stopped, in fact, trading the system, and when I entered it in the real world, which we can't look at here due to regulatory issues. But this is what you get. Okay, this is interesting. What happened here? Okay, so usually there should be the number of trades we look at here, respectively. No, not the number of trades, but I think it's this is blacked out because there was the data, the dates, and then it just didn't look pretty well. Whatever, doesn't matter. But what you can clearly see is that we are analyzing here 314 trades with a hit rate, in fact, of 41.2%, which is not tremendously good, but the payoff ratio here of 0.235 to 1 results in a quite impressive equity curve, which means we only saw a max drawdown in percentage here, percentage-wise of 5.2%, which is quite low when risking, in this case, or when trading. I think there was a fixed position size I traded with, or I used here with 0.4, I think, on a 10,000 euro account. So which means 0.4 means 40,000. It's an effective leverage we're using here of 4 to 1 in this case. And yeah, the only problem is that the longest streak, it's nearly 1/3 until we saw new equity highs, was 114 trades. But the gain, including commissions, by the way, so you can see it's inklusive Kommission. This is the German wording, including commissions here. So the net performance was 69.6%, which is quite impressive, I think, over such a time span for a quite easy and not very difficult to understand trading strategy here, in fact. And what could we do now? You probably remember 2 weeks ago, we had a webinar. We called it Monte Carlo Simulation, or Monte Carlo Simulations, where we used Bernoulli distributed Monte Carlo simulations. And we could use this now and optimize the position size. So some of you probably say, hey, is there a chance to probably work with these with this knowledge on Monte Carlo here, respectively on Kelly especially, to optimize the position size? Yes, it is. The only problem is due to here, this hit rate of only 41%, you will create a quite impressive, you will naturally get a quite impressive Kelly Kelly equity curve, or Kelly optimized equity curve. Unfortunately, drawdowns will spike massively up here from 5.2% to sometimes something like 40 and even more percent, which is from a mathematical standpoint completely fine, because you say I only look at the optimal growth of the equity curve when optimizing the position size with Kelly. The only thing is that if you trade this strategy here with your or within your portfolio, it should be only traded within a small part of the portfolio, because having drawdowns of more than 40% is just, especially from a mental perspective, something to definitely be careful about, let's put it that way. But as you can see, again, back to the setup in general, you can see, even though it looks, again, very simple, it is in fact very simple. It's an MA system with this sentiment filter on top of it, and you only optimize it in regards to the position size based on a volatility-based stop here. You still get a quite impressive equity curve over time, in fact. Yeah, and so let's sum all this up here. So the basic idea is of the strategy is, in fact, we use cognitive biases or natural human behavior as a filter in our trading. So we use this knowledge, then the retail sentiment, then in combination with an MA crossover system to gain an edge in our trading. And our target is to use human loss aversion as the filter to get down the position size. So in fact, what we haven't looked at here is, or what didn't become probably obvious, is that you reduce the trading frequency. So you take out all these trades where you would position yourself in direction of the retail sentiment. Which means you cut down the trade frequency, you cut down the costs you naturally have, because you're only trading 50% of the cases you would do if you trade the basic strategy and take all system signals, or signals which are generated within the system, while you increase the likelihood of being on the right side of the trade, since you're not trading in direction of the retail sentiment, because you're here using natural behavior, which will naturally result in losses in retail trading. You'd cut these out, in fact. So you increase the likelihood of being profitable within with your approach, while reducing the trading frequency and reducing trading commissions, which will naturally result over the long term in a high profitability of your trading, in fact. And so once again, the basic idea is that you only take long trades once the retail sentiment is net short. Respectively, you only trade short trades if the retail sentiment is net long. And that's in fact it. 1 second, please. I have to 1 second. Okay, now I'm back. So, and yeah, that's in fact everything on this topic. I have to say, if you have questions now, which is probably natural, please feel free to ask all the questions here within the Traders Yard community. So if you have any questions, I think the link was already published. You will find it in the YouTube video here, in the description, respectively in the chat box. And once again, you also find it in the chat box already. Yes, I've seen it here. So feel free to ask all your questions you might now have on this strategy. We, or in this case, especially me, I'd be really, really happy to answer all your questions. Don't forget to join us next time. That's on Monday with Paul, which will tell you more about trading key reversal price action candlesticks, or the candlestick in this case. He will answer questions on what is a key reversal candle. Oh, I'm sorry. What is a key reversal candle? He will answer the question of where do they show up. He will also show you the best way to trade them. And yeah, when it's on Monday, it's in fact 2 p.m. GMT then, because we have a switch here in Germany with the time. So next week, this is something which is very important also for the setup. We are trading here in our Traders Yard community. So what do? I track the performance here, and I post every day. In the morning, European market opening, and also then in the afternoon with the S&P 500, I post a trading idea based on the open range breakout, which we also had as a topic here in this trading spotlight webinar series. And there you have the current results. So we have a history now, still not very much. It's only 35 days, but yeah. So we had some good trades, we had some bad trades, and currently we hope to make shortly new equity highs with this approach. But it's not about the performance, in fact, but it's about how to professionalize your trading and how to get consistency in your trading, and then how to use the generated data, in this case here, on the hit rate, on the average gain, on the average losing trade, and then how to start to optimize your trading, in fact. So what profitability in trading is all about, and what professional trading is all about. So, and here we have the start of the US equity markets 1 hour earlier due to this change in the daylight saving times, which we now take out here in Germany, respectively in the European area. So, and then where you get the inbox, where you get the link to join the webinar, the live event, check your inbox for the webinar link. If you're watching this webinar on YouTube, by the way, you liked it, thumb up, please. That would be much appreciated. Yeah, if you want to register, head over here to this URL, go to the website, admiralmarkets.com, and there go to education, and here the webinars tab, and there you can register for this trading spotlight series. There you have the URL once again. And as usual, regulation was something which we spoke about at the beginning of this webinar. This is why we have to show here the risk disclaimer, and that's it from my end. I hope it's all. Yeah, I hope you enjoyed the webinar. I wish you all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week and on Friday. Yeah, I hope to present you something spectacular then also. So that's it from my end. All the best. Talk to you soon. I look forward to it. See you, and bye-bye.